All right. Curiosities, conspiracy, hot takes. Yes. Collapse, financial markets. Curious thing. So today being, gosh, what? Give me a second. I'm sure I'll get a yes. So it's Thursday, and we're on March 28th. Just a time frame. Again, our financial markets creeping to all-time highs, high industrials, etc. Tech basically carrying everything, which is curious. Not even a blip when a major hub, major port, part of our supply chain and infrastructure is completely taken out. A mile long bridge, and who knows how long that is going to take to repair, what kind of issues are going to arise from that. Not even a blip. Not even a blip. In fact, I think industrials popped this the last few days when this had occurred. And and the curious thing is that your gold is also popping with it. Now, I know that the way they have the weird algorithm set up and such that they relate these things to your interest rates and anticipation that the Fed is going to cut rates, and all of these variables are put in, and so the basically high frequency algorithms do the trading for the places. But everything going up at once together, um, it's not good. You are combining that with the fact that people are finally now noticing our debt curve is going exponential. Now, from the very beginning, I mean, geez, I've been on Twitter forever. I don't know. Nobody looks at any of my tweets. I don't think it really matters. But since March of 2020, when they passed through that first $1 trillion stimulus, I had said this is going to be bad. This is hyperinflation. Once you spend this money, there is no going back. We are going to go on that curve. And once they were starting to suggest they were going to do the increasing of rates, I think they were doing that to stall out the effects, not to stop the effects like Volcker tried to do back during the early 80s terms when he had to crank rates and rates would run. I think they were at the highest 21%. But I believe it was a stall tactic because what you've noticed is, and people have finally seen, oh, it went up a trillion in 3 months. Well, way back in 2020, it had run a trillion in, say, 10. Okay. And then you saw it at 6 or 7. And then, I had said, well, wait until you see it. It's going to squeeze down to 4 or 3. And then you're going to see a trillion every couple of months. It runs exponential. It's a parabolic increase. The reason why is because the outflow of money isn't actually supporting any productivity. The only increases we have seen are in government and social expenditures, neither of which are productive. They just absorb on supply, which just causes prices to increase even faster. And for those of the people who don't understand, inflation is the money supply. It's not the increase of prices. Prices increase. It's an effect of it. The reason why, I mean, really simply, let's take an eBay market. You've got 4 people betting on a particular item, and so yes, that item and what they bid on it is going to have certain value characteristics to the individual, like how much they actually would get value from grabbing it, but it's also going to have the income effect. Somebody who's got a higher income than others can obviously bid more. But let's just say everybody's even, okay? Everybody's going to start out at 10, and everybody wants it pretty much the same. And so they start putting in their bids. But say that $10 also has to maybe go to other stuff, food and survival or whatever, just as a percentage piece, just as a breakdown, right? 10 is a nice, easy number to think about. We'll just pretend like prices are low. So people go up and say that the bidding, somebody was able to think that they could get by with ramen, and they were able to bid 8, okay? And now what happens when you give somebody 10 more and the other people don't have any? Well, then that person, the money that they have doesn't mean quite as much. They could actually, if it was the person who bid 8, could easily go to 14. And then they still have money left over if the other people have to still consider what they're purchasing. But what happens when all the people get an increase of 10? Well, then the price of that item immediately goes up because everybody can bid more on it relative to what they were actually making. But that's the same thing for all the prices. So if that person had bid 80% on it, 8 out of 10, well, then they probably, if everybody got 10 more, the prices would elevate, and that 80% would then be 16 out of the 20. And that's what would happen. And that's what happens with everything. And granted, this is, it's a small little scenario and it's extremely simplified, but that's how marketplaces and prices, end up, how it actually occurs, because everybody on some level, usually all the way back to the commodities, when you're bidding on things and you're trying to fight for contracts, the people who are supplying the commodities are going to supply the goods to the highest bidder. But there is going to be a relative amount given the general market, the total amount supplied, the number of people who desire it, right? That's supply and demand, just like bidding on that item on eBay. And so this is where it comes in. If everybody is getting more money to purchase things, and this can be through, government contracts, which again, it's printed money out of nothing. Although, you could debate that if a government contract is productive and, for example, saves time, like you build a bridge and people save hours driven, save fuel, saves all these things, well, then you can kind of justify the cost for that because it is economically productive. If you're just giving people money who haven't really been productive to do anything, then no, it isn't productive. And that's an awful lot of government workers. And I mean, even if you go into the social welfare aspect, the fact is the government doesn't really have the ability to do that. Social welfare is unconstitutional. And if you really get down to it, it's a bribe. You are bribing people to vote for you because you have given them money from other people. It's the transfer. It's, as soon as you go into that, it is a socialist communist system, and we've been in that for a long time. But nonetheless, looking at what has gone on, everything increasing at once, people finally starting to accept the fact not only that major inflation is going to be taking off, and we are probably going to see what, and it's not like it can't happen. I mean, Argentina, Venezuela, people do reference Zimbabwe, but they never really understood why it did. But we are going to see this. And it's so interesting now because I shouldn't say all, but a number of the finance people, finance advisors, investment advisors, and so on, are now being told how to look at gold. Where before, it's a barbarous relic. What are you investing in that? I mean, this attitude is now shifted because all the people who are, in the know within these investments know this is bad. And when your advisor starts to begin to address things like looking at gold for your portfolio, you know that there has been awakening in the general populace. Oh, hold on. Thought on gold. I'll be right. All right. So back. Gold. So if everybody is now moving into gold, that there has been something in the general, we'll just say Main Street folk, possibly even the wealthy. I mean, maybe some of them are waking up now to it. But they have been moving money to purchase gold. I mean, you've seen it at Costco. Costco is actually, offers the gold bars or the silver bars, and people are buying them out as soon as they come in. And so now the investment people are freaking out because here's a little secret that I will tell you, that they don't care if you make money. They will ride your money until it runs out. And people probably can remember this from the housing collapse over the period, 07, 09. They will ride your money all the way into the ground as long as they get their percentages. If you're a hedge fund, what is it, 2 and 20, you get 2% of 2% of the investment and 20% of the profit, right? And you get your fees back somewhere. I mean, those things vary, but you get your fees every single time you make your trades or whatever is coming into your contract. But point is, they don't make money if you're not in the system. So it doesn't really matter. All these guys can think the entire thing is going to crash, and maybe their whole portfolio is somewhere else, or maybe they actually believe that somehow there's still going to be a finance system. But the point is that they need to convince you to keep your money in, because otherwise, what are they going to do for a job? I mean, just bear that in mind. They live on your money. And I mean, it's quite similar to government, because government takes your taxes so they can pay themselves. It's the exact same thing. Although it won't be presented that way, because you will be presented that they can make you money. However, if you were to really dig into it and you find out that, what is it, probably 3/4 of them don't beat the market, which means they don't beat the S&P. If the S&P went up 4 or 5% for the year, guess what? They probably went up 4 or 5% for the year for the portfolio. They don't beat it. You could have just put your money as in the market and you would have been fine. Very few actually beat it. And the real investments don't come from actually doing equities anyway. It comes from actually equities in the market. It actually comes from businesses. And there's nothing like productive assets to actually give you a return. And that's where your investments are, which is why private equity firms buy companies. Okay, just as a reference, just to think about that. Nothing returns like a company, you know. That's where your real margins of return are. But not everybody has that opportunity as well, because, lo and behold, the government got to choose and select who were qualified investors, et cetera, et cetera. Some of it is, once again, the issues that come in with administrative costs, and people, again, you forget about that. There's administrative costs in all kinds of regulation and filings. Those are fun. Actual certain upkeep, maintenance of accounts actually does occur, especially when you have to put in or transfer or put in the information and send out filings, et cetera, et cetera. So some of that does stink and is there in there, but people don't want to do this on their own. They want somebody else to do it for them. And so this is where these costs come from. I mean, but anyway, point being, going back to it, I hear so many people talking about how it's going to be really bad and how we now might see hyperinflation. But guess what? The markets then probably don't really exist. Or they just, you know, they either hyperinflate out, everything goes to poof, and that dollar is poof, or they crash and it goes poof and you lose everything. Either way, in either scenario, you're not good. You're not good, but somehow people are trying to tell you that they can, you know, have a proper portfolio for you to invest, et cetera, et cetera. Not if you're in the area which is going to go poof. And you should look into this. You should look deeper into this, because it's your stuff that's going to go poof. There's nothing like real assets, real productive assets. And that's the end all be all, but none of those folks are going to make money off real productive assets if you go and buy them. Okay. They make money by staying in the market as it's played. Right now, I think you can, and many of them will tell you that it's a paper market. It's being, you know, it's the paper aspect, especially for forward contracts for commodities. It's manipulating or hiding the real value of the price. They're still, you know, suggesting things to invest in. It blows my mind that this is how it works, because if they believed anything about what they said, they would tell you not to be like looking at this stuff and to go have productive, real assets. But that's not what they tell you. And so, I mean, everybody, it's to each their own. You have to do your own, you know, look into stuff. But there's, again, it goes back to honesty, integrity, and dependence. If people are depending on something like that, there's a conflict of interest. It's integral in the actual position. It's a conflict of interest, because they can't really tell you the truth, because then they lose out on what you have with them. Does that make sense? They lose out. It's a conflict of interest. It's inherent in the position, especially during bad times. If you're in good times, hey, hunky-dory, it's fine. Yeah, go, run with it. But not in bad times, especially not in collapse times. It was different when you look at Carter into Reagan. And from there on out, entirely different perspective, entirely different set of circumstances, because we were early on. We weren't at the end stages of the fiat collapse. And if you go before that, you go before Nixon, well, we were still basically on some kind of a rough standard. I think the foreign exchange window for changing for gold was 74, I think, 71, 74, somewhere in that range. That's when they did the petrodollar with OPEC and Saudi Arabia. And that was the beginning of the fiat currency. But notice that they were still swapping gold for oil initially as a benchmark. Nobody really thought that was going to work, which is why everything bounced around all crazy, and people weren't real keen on it. But guess what? Everybody needed energy, and so eventually everybody had to buy dollars, and so all of that inflation will eventually be exported other places, and that's exactly what we saw. And so everything smoothed out. Little did they know that the ability to print never-ending dollars and money, or seemingly never-ending dollars and money, not only would cause the lower the purchasing power of the dollar, but it would, which was saved, by the way, because goods were created in areas in which it was significantly cheaper to do so. So it masked that over that time period. But also by creating all of these dollars, guess what? You got to create all of these entities within government to oversee all of these things, and they didn't need real accountability, because they were going to be funded by the government entity. And so, I mean, that's where you get all of these nonprofits and think tanks, et cetera, because they are funded by the port projects from the government. And you'd find out that most of these are now the source causes of what we actually see in our whole culture war that we've got going on right now. Okay, so back inflation part. As a real quick bit, I'm probably cut here because I paused for a little bit there, but if you need a reference point, the only reference point you need to look at is Weimar. That is it. You will see what happens when you restrict productive assets and restrict supply, and how hyperinflation occurs. Because Weimar, after World War I, the quote-unquote allies went in and seized the majority of the productive assets, mining, forestry, and so on, of Germany. Okay, they seized them. So none of these were able to be harvested or exported for trade. But then they went and they billed them for the war as reparations. This is where the original thing for the reparations payment would come up post-war. Well, what were they going to pay with? They didn't have anything to trade. So they just printed money. And that's where nobody wanted to take their money, because they couldn't use the German dollar or the German marks to purchase anything, because the Allies had already seized all of the things that they would normally purchase, all of the commodities, resources, and productivity. So they couldn't do anything. So it hyperinflated everything, and nothing could be shipped in or traded because there was nothing to trade for. And so the entire economic system was also collapsed. But what they didn't count on was the fact that most of the people would tend back to the land and go agricultural and animal husbandry, and then the finance, I believe it was finance minister, would develop a basically a debt bond backed by the productivity of the agriculture, and that would act as their temporary currency. And then they were able to start rebuilding from there, eventually to even go on and go back to an interest-free money system where the government actually created and produced productive economic structures like bridges, roads, etc., and use those values for which to then create a money system. And so it was a positive based as opposed to a debt based system. And so they would pay the workers via the actual value with which that project was supposedly going to do for the economy as a whole. And then in that way, the money always balanced with the assets, and they had a very productive society. It is an overlooked system, probably because of the fact that it isn't debt based, and it actually shows that much as any country, they should be sovereign to print their own money, and it should be interest free, like Lincoln and the Greenbacks. But you know, and as soon as that ever comes into light, you'll notice that these people are, you know, quickly taken from this world. And so, you know, maybe we'll get further into the money magic and the debt-based system versus asset-based systems. But for now, Weimar is your example for the inflation. We are going to see it because, as I said, they are cutting off supply, they're cutting off food, they're restricting things. They're going to influx people because more people, fewer supplies, prices take off, the money becomes worthless. The energy systems are shutting off the Western nations, which are the most productive middle-class nations, all of Western Europe, Australia, New Zealand, the US, Canada, and they are shutting them off and implementing full techno-tracking systems. How do you think this is going to pan out? So anyway.